Welcome, everyone. Thank you so much for joining us for buying a home with HomeStreet Bank. We're thrilled for you all to be here. My name is Diana, and I'm here with the whole you. Our presenter today is Jessica with HomeStreet Bank. I'll go ahead and turn things over to you to get started with our presentation. Thank you, Jessica.
Wonderful. Thank you. Thanks so much, Diana. Hello, everyone. Like she said, my name is Jessica Santana. I'm a loan officer at HomeStreet Bank. I have been financing homes now for 26 years, and I'm so excited. My clients now send their kids to buy, and so it's a very nice stage of my career. I'm here to help you understand a little bit about home buying, and I want to just walk you through the outline first. And then, of course, please, if you have specific questions, if there's something in particular you wanted to learn by joining this class today, please make sure to ask the question so that we answer it before the class is over, okay? And you can, of course, reach out to me after the class as well if you'd like. Okay, so let's go ahead and get started. And first, I want to start by just saying that the sum of the class outline is going to seem super basic, and I'm going to just make those very basic subject points as brief as possible, and we'll move on to what I think is the most important information that you probably want to learn about, okay? So please, again, feel free to reach out and say, hey, I really wanted to talk about X. And if there's no time, we can definitely talk about it after class. Okay, so we're going to talk about the benefits of home ownership, right? Building equity, some possible tax benefits, having stability, predictability, freedom in community, and retirement, right? These are the things that I think are just very standard benefits of home ownership, like why would you want to buy a home, right? And then we're going to talk about just home buying basics, like some loan amounts and loan types and credit scores, closing costs, and what you should expect. Documents that are needed in order to get a loan approval. And then we're going to jump into the next topic, which is buying a home. And we'll give you a big, quick overview from beginning to end so that you understand kind of what the process looks like. Once that's done, we'll look briefly at the benefits that you're eligible for when you receive, when you get your home financed through HomeStreet Bank. All right, so let's go ahead and get started. The benefits of home ownership, right? Why rent and buy as opposed to continuing to rent? And of course, one big benefit is equity, right? As the value of your home goes up and the principal balance of your loan goes down, that stuff in between is equity. And you may be able to access that amount of money by borrowing it so that you can repair the home in the future, or perhaps that could be something that supplements your retirement in the future, right? So equity is something that's very important. It can also help you to build credit, right? Having a mortgage payment and making payments on time over a period of time may be able to help you improve your scores. You're going to have some tax deductions at this time. The interest that you pay on the mortgage and the property taxes are tax deductible. But of course, see the small print in the screen. After 2017, you had two options. You could itemize, and you have a specific standard itemization, standard deduction in place. And if that is greater than the deductions you could get by writing off the tax and the interest, then you're going to just go with the higher standard amount. So you may or may not see an actual dollar amount benefit in terms of deducting taxes and the interest of your mortgage. Just depends. So consult with your accountant regarding that. So it's a possibility of being able to see a reduction in taxes by owning a property. All right, and then stability. If your interest rate is fixed, then the principal and interest portion of your payment is going to remain steady as opposed to rent, right? Where you continue to have rents increase, then you may have rented at this place for 10 years and you walk away with nothing, right? So definitely having that stability of an interest rate, principal and interest portion of your payment be stable can really help. It also is going to be something that's, once you start making payments year after year, you'll have the ability to determine how much it costs to maintain the property and have include that in your budget, right? So that you have some, you can predict what the expenses will be. All right. So of course, freedom and community, right? If you have a pet, I don't know how many of you do, but you could, if you buy a home, you may be able to, you know, have any size pet you want. Maybe not. So there are some condos that have some restrictions, but overall, for the most part, you could paint the home the color that you want and have the pets that you want and remodel it and have that sense of satisfaction and give that home the personality that you want. And then, of course, absolutely, people that rent tend not to take care of the place where they live as much as when they own it. So you get this sense of community and pride. And usually homes tend to be better taken care of, right? So, and of course, retirement, right? Supplement your retirement so that not everything is in stocks and not everything is in your 401k, but supplement with real estate so that you diversify, and that's the name of the game. The other advantage, of course, is think in terms of lowering that principal balance and paying that mortgage off as quickly as you can. Because not having a mortgage payment would be just so sweet, right? And amazing. And that is something you have control over, right? As opposed to predicting the values going up or coming down. We cannot control that, but you can control paying that mortgage down and having no mortgage payment. All right, so let's jump into homebuyer basics. So the first thing that you want to do is create a little budget, right? And just figure out, okay, so how much am I paying for rent currently? Could I maybe make payments that are $1,000 or more per month? Let's say you're paying $2,000 a month. If you think $3,000 per month feels very comfortable, you could start practicing that, right? That's why it says savings goal, start making the future mortgage payments today. So make believe that you need to pay $3,000, right? No excuses, and see how that feels. So I think that's the best way to budget, is just figure out, okay, where do I stand? How much am I paying right now? If right now I'm struggling, well, maybe I need to pay a couple of other things off first before purchasing a home. And then, of course, take a look at plan ahead for property taxes and for maintenance, right? Because once you purchase a home, the water heater, the roof, the paint, you'll need to plan ahead for those expenses. So we just want to make sure that you are prepared. And so that's when you think, okay, well then how much money do I need? I want to buy a home, right? I think the biggest misconception is people think you need 20% down, and you don't. Okay. One quick note that I want to make here, just briefly. And you guys, it's not in the outline, so I'll give it to you. And if you need me to send you an email with the information later, I can. So in Washington State, and this is for conventional loans, okay? Loan amounts that go from 0 up to $726,000, you only need 3% of the price as down payment. That's the minimum down payment required. Between $726,000 and $977,000, you need just 5% down payment. So the misconception is that you need 20% down, and you don't. Okay. It depends on the loan type, right? If you are if you're VA eligible, maybe you served in the armed forces or the military, and you're able to purchase a home using VA financing, you need 0% down payment. So those are just the down payment, right? Then we need to talk about closing costs. And so the closing costs are the cost of financing the property. And so I would say that overall, just a brief rule of thumb is for you to think of 2% of the loan amount as extra money that you're going to need in order to cover the cost of financing the home. And that's recording documents at the end. The courthouse will charge per page, right? And that's around $450. You're going to have title and escrow, the notary that handles the closing at the end. You're going to have home insurance against fire. And you have the credit report, the appraisal. So the cost of financing the home, okay, that has nothing to do with the down payment, and you should be prepared. And so since loan amounts and loan types and the closing costs vary, I think it's a nice rule of thumb to just think 2%, right? Have that in addition to your down payment. And then reserves. Should you have some savings for emergencies after closing or not? And depending on the loan type that you end up getting, it may reserve money for emergencies, may or may not be required. For the most part, they are not. Usually loan amounts that are higher than $977,000, those are jumbo loans. Those do require that you have plenty of money in reserves for a rainy day, but otherwise they don't. And so I think it's completely up to you to plan ahead, right? To be super smart and to have some money set aside for a rainy day so that when that water heater breaks, you have enough money to tap into. All right, let's talk briefly about credit scores. I don't know how many of you have taken a look at your credit report and if you have recently or not. But credit scores are super important when you're buying a home. They're super important in general, right? They affect your car insurance, your home insurance, credit card rates. And so when you're buying a home, same thing, it's a huge piece of getting the loan approved. And so something briefly that I want to share with you regarding credit scores, depending on the loan type, right? You don't want your credit score to be less than 580. So that's like the minimum for most loan options out there, depending on what kind of loan type you're going to end up getting, okay? There are 3 national credit bureaus. There are 3 scores, usually a little bit different, that we all get. We don't take the highest score or the lowest score. We're going to take the middle. And that's what we're going to use to determine your loan programs and your interest rate. So knowing roughly what your FICO score is very important. And I'll briefly also touch on FICO is the model that we use in the mortgage industry. When we pull our credit scores, they're FICO scores. If you're using, for example, Credit Karma, Karma is a great way for you to get your credit scores, but they use a Vantage credit score model. And that means that their credit scores are going to be between 10 and 20 points higher than FICO. So that's totally fine. Just plan ahead and know that the scores we are going to get are going to be about 20 points less than Karma, okay? So FICO is what we use. And then what determines a FICO score then, right? So I would say 2 most important things that I want you to note. The rest of them are right here on the screen. But one is, of course, your payment history. If you make your payments on time, your credit scores are likely to be higher. And if your credit history is brief, maybe you've always paid on time, but you've only had history for about a year, your scores are likely to be lower than someone else who maybe has been making payments for 5 years, for example, right? The next thing that's super important that affects your scores has to do with credit capacity. And what that means is the credit limit in relation to the ending balance of your credit at the end of the month or at the end of the billing cycle in relation to that credit limit. So, for example, let's say your credit card is $1,000, has $1,000 credit limit. At the end of the billing cycle, you don't want that ending balance to be more than $250 or 25%, right? We want to try. So if you're trying to improve your scores, that's a really quick, easy way for you to improve them, is just be mindful of the ending balance at the end of the billing cycle. And then keep in mind that the bureaus don't look at the fact that maybe you pay off your cards in full at the end of the month. If the ending balance on your bill is higher than 25% of the credit limit, chances are your scores are not going to be as high as they could be. Okay, so just keep that in mind. The other thing that I want to point out in terms of credit history is that unsecured debt compared to secured debt has a bigger impact in your scores. And what does that mean? For example, student loans are insured or backed up by the government. Car loans are, the collateral is the car, right? If you don't make a payment, they can knock on your door and say, give me the keys back. Credit cards, however, are not secured, right? If we don't make a payment for whatever the reason, they can't take the dinner back. So credit cards have a higher impact on your score. Doesn't mean that these other two do not impact the score. It's just that credit cards have the highest impact. So you just want to treat them very carefully, okay? All right, so documents that you need to when you want to get a loan approval. So let's talk about getting the loan approval versus a pre-qualification. So a pre-qualification is my favorite, and I do this with all the clients who are thinking about buying a home. I schedule a 30-minute phone consultation or in person, and we just number crunch. We're not going to run a credit report. We're just going to help you understand what your options are. We're going to look at, I always say, okay, what's your gross income? So pre-tax. What are the minimum monthly payments for debt? And that's car loans, student loans, credit cards, child support, personal loans, right? What are those? Roughly, what's your credit score? So again, if you don't know what your scores are, you could go to annualcreditreport.com and you could get your scores there, take a look at the bureaus and your history there before you talk to a lender. And so I'll ask you, again, pre-qualification. I'll ask you, okay, what's the score roughly? And then how much money do you have saved? And of that money that you have saved, how much are you considering investing as down payment? And with that, then I'm able to say, oh, okay, so maximum monthly payment you may qualify for is $3,500. And $3,500 equals, and I'll calculate and I'll say, okay, that equals this purchase price. This would be the monthly payment roughly, and this is roughly how much money you're going to need. And that's it. I haven't run credit. You haven't shown me your documents. We just had a conversation. I can send you a little estimate that shows you a scenario so that you can go back and take a look at it. And then if you're feeling ready and you're like, oh my God, I don't know what I'm waiting for, then you can move towards a pre-approval. And then that means you're actually applying. So you complete an application, whether it's in person, over the phone, or most people go online and complete an application. And then I will run a credit report. So that will be a hard inquiry. And then pre-approvals are good for 4 months. So the credit report is good for 4 months, okay? I'll ask you for the documents that you see listed there. I'll take a look at pay stubs, W-2s, bank statements. And then once I look at all of that, I'll run the application through a software. It's called Desktop Underwriter. And once I get a response that either says approve eligible, then I issue a pre-approval letter, which is what goes to your real estate agent. And your real estate agent needs that letter in order to represent you in making an offer on a home that you want to buy, okay? So if you're wanting to make an offer on a home, you have to have an application, a pre-approval, and I'm going to need a credit report. If you just want to find out what your options are, we just need a pre-qualification, okay? And that can be on the phone or in person within 30 minutes. We can help you determine your options. All right. Any questions at all, please reach out, okay? I hope this is not too fast. Okay, so then buying a home, like the big overall picture, right? From beginning to end, from the moment you get approved to the moment you get your keys, usually it's about a 30 to 45-day period. That's how long it takes. I've seen loans close in 3 weeks, right? It just depends on what you need. But I would say 30 days is a pretty good average. All right, so we'll start with either a pre-qualification or pre-approval, have that conversation with your lender, determine kind of where you stand, get a loan approval, figure out what that maximum purchase price is, how much money you're going to need, what is that maximum monthly payment going to be, and then make sure that you don't exceed that price as you're out there looking for a home, right? Then we'll connect you with a real estate agent, or if you have one, make sure you introduce the agent to your lender, introduce them to us, and then we will give them the pre-approval letter, and you can start looking for homes, okay? When you're making an offer on a home, of course, you want to make sure that it stands out, that you make it competitive, right? So being able to close quickly is a way to make that more competitive. How much down payment you have is something that sellers do look at. And of course, sellers want the highest price possible, right? I am seeing a very mixed market out there, and I'm seeing more multiple offers again. And so it's starting to get competitive one more time, but not on every home. Some homes don't have as many multiple offers and as some of them do, all right? But it's starting to change a little bit again, more into a seller's market. All right, so you make sure that your offer is competitive. You find a home that you like, you make an offer on the home, the seller accepts the offer, and now you are in contract. So that will give us the exact purchase price, will tell us when the loan will be closing, like when the closing date is. It will say who escrow and title will be. That's the company that's gonna handle the closing of the loan. And then you'll immediately talk to the lender, let us know, hey, Jess, I got my offer accepted. Yay, let's lock that interest rate. So meanwhile, you got approved, right? But you're not locking the interest rate. It's a letter that says you're approved based on current market rates, right? And based on your income and assets. But you lock a rate when you have found a home, the offer is accepted, because now we'll know what the price is, what the address is, what the taxes are, right? And then you can secure that interest rate. Okay. Usually when you make an offer, you're going to have contingency. So you make the offer contingent, for example, upon an inspection, or contingent upon the financing of the loan. So normally it's subject to inspection. So you block your rate, have that inspection, you meet with your real estate agent and an inspector, and the inspector is takes about 3 to 4 hours. You wanna be at that inspection, walk with that inspector, have them take a look at the crawl space, at the roof, make sure all the windows open, whether you have any kind of gaps between the window and the floor, and any kind of drafts, whether the heating system works, plumbing, they look at all the appliances, the toilets, the showers, take a look to see if you have any humidities and so on, right? So a good inspector is going to tell you, this is the overall condition of the home, this is what immediately needs to be fixed, and this is what you can expect in the next 2, 3, 5, 10 years, right? And so let's say that there are some big problems with the home, like maybe there's a big sewer problem, right? Then you can go back to the seller and negotiate that contract with the seller, see if they are willing to fix it. Or maybe the repair that's needed for the home is not so big that you're like, we can do that after closing, no problem, moving forward. Or maybe the problem is so bad and the seller does not want to fix it, and you can walk from the transaction, right? And you go and find a different home. And so for the most part, you can, if you come to an agreement, then we move forward. And after the inspection, then that's when we, the lender, order an appraisal. So how is an appraisal different from an inspector? So an appraisal is another one of those costs, the cost of financing the home, usually around between $700 and $900. And the appraiser is something the bank orders. It's the eyes to the bank because we don't get to see the home. And they will go out to look at that home that you want to buy. They get a copy of your purchase and sales agreement, so they'll know what the price will be. And then they're going to compare that home with 3 other homes that have sold in the past 90 days, homes that are similar in size, similar in location as the one that you're trying to buy, similar in qualities and characteristics, right? And they'll give us their opinion of value of the home. So that's what an appraisal is. And the lender is going to lend based on that appraisal. If the appraised value comes in lower than the purchase price, we're going to lend on the lower of the 2. So if the appraisal comes in lower, you'll have to go back to the seller, renegotiate. Maybe between you and the seller, you come to an agreement to split the gap between the appraisal and the price you agreed to pay. Or maybe you determine, hey, you know what, we're going to go find another home. For the most part, they come to an agreement. Okay, either the seller lowers the price or you guys come into the table with more money to bridge that gap. But basically, the appraisal tells the lender and you how much that home is worth, right? And so once the appraisal is done, then we'll have your credit report, your income documents, the title, the appraisal, the home insurance, and we'll send that to underwriting for final approval. Once we have final approval, then we'll be able to get those loan documents into escrow. So escrow is a neutral party, right? And escrow is does not represent the seller or the buyer. It's a neutral party that makes sure that the terms of the contract are met, that the seller did what they said they were going to do, and the buyer brought their money and their loan and did also what they said they were going to do. And so you sign your final documents with them at closing. After you sign those documents, they send them back to us, the lender, and we're able to review them, and then the loan will fund and close, and we'll get that to recording. Once the loan records, then it's official. Your names will show up in the public records, and you become the owner at that time. Here, I want to also say, let me see. Yep. Once the loan records, then of course you get your keys, and that's when the loan has closed. Okay. So going back again to the beginning, you make an offer on a home. When you do, you're writing an initial check, and that's called earnest money. And so that signals to the seller how serious you are about purchasing a home. And it's part of your down payment. So let's say that down payment and closing cost, we said that you would need $30,000 total, right? If the earnest money, the initial deposit that you make is $10K, then at the end at closing, when you sign final documents with escrow, you're going to need the remaining amount of money, so that $20K that's left, okay? This $10,000 earnest money is what's at stake in case you change your mind halfway through and decide you're moving to Hawaii, right? If you leave the seller hanging, the seller could keep that money. But that's why you have contingencies in your contract, because that protects you. So let's say you put in your $10,000 earnest money, and then you have an inspection. You want the seller to fix the roof, for example, and they will not. You could then say, okay, I'm not buying this home, and you would get your earnest money back because you had an inspection contingency in place, all right? So again, the earnest money is part of the total money that you need at closing. And at the end, at escrow, you will simply have the rest of your money that's needed brought to the table. Sign final documents, it all gets recorded, and then you get your keys, okay? So that's pretty much how that works, and that takes about 30 days. The other thing that you may want to note here, let's say that you're closing at the end of April. In May, you do not have a monthly payment until June 1st, and that's because June pays for May, and July pays for June. So interest is paid in arrears. Basically, you live there first and then you pay, right? So it's going to feel like a free monthly payment, but it's not, right? Just your wallet will be happy. All right. Any questions? Again, we can talk about whatever you guys would like. Once I'm done with going through this outline. The next thing I want to, Next thing I want to talk about is your affinity benefits. So let's talk about those briefly. Okay, so you're going to, by working for the University of Washington, you are eligible to receive benefits when you finance the purchase of your home or you refinance in the future through HomeStreet Bank. And so we provide you with cost savings, and that includes 0.5% of the loan amount as a credit towards your closing costs, the cost of financing the home that I talked about earlier. So let's say your loan amount is $500,000. 1% of $500,000 would be $5,000, right? Half of 1% would be $2,500. So you would get a $2,500 credit towards closing costs at closing. Okay, if it's $600,000, it would be $3,000, and so on. Okay, so half of 1%. And then we have participating real estate agents that work throughout all of Washington that we can connect you with. And they also contribute from their commission towards your closing costs. So how does that work? Real estate agents get paid by the seller in Washington state. The seller pays the commission of the listing agent, the agent that's listing the home for sale. That's the sign out there that says John L. Scott or Keller Williams, right? The seller also pays the commission of the buyer's agent, the agent that represents the buyer, you in this case, the agent that brings the buyer to the table. So the seller pays the commission of both. And so if the real estate agent that you're working with that represents you, if they are an affinity agent, if they get 3% commission, they'll take 1% of the price and contribute that towards your closing costs. If they get 2.5% commission, they'll give you half of 1% of the price. And if they get 2% commission, there's no room to contribute anything because they need to survive, right, and pay taxes and make a living. Usually, new construction tends to pay lower commissions, where they're like, you know, take it or leave it. But for the most part, they get either 3% or 2.5% commission is what I'm seeing out in the market now, okay? So if you have your own real estate agent now, that's totally fine. We can still work with your agent. They just might not be willing or able to make a contribution, and that's fine, okay? If you don't have a relationship with an agent, we can introduce you to one that we have been working with for a long time, and our agents do contribute. Okay. Down payment assistance, as I mentioned earlier, is an option. You can borrow the down payment. It's not a grant. It's not money that you don't have to repay. You do repay. The most popular program out there is through the Housing Finance Commission, and you basically borrow the down payment. You can do that if you make less than $180,000 a year. Your interest rate will be a little higher than it would be if you bring your own money to the table, but it's an option. And we can certainly talk more about that after the class. We also offer you guys financial fitness, right? So here we are teaching you about home buying. So education is super important to us, and we think it's great that you are well prepared when you're making big decisions like this. Your benefits are also available to your immediate family. So if you've got brothers, mom, dad who are purchasing a home or refinancing, they could benefit from these benefits as well. And then super important is that you understand that these benefits, you can access them, but not by just walking into a HomeStreet Bank branch. Most branches are not aware of the benefits and may not know what you're entitled to. So please, if you can, in order to be able to access them, go ahead and here's the contact information. You can access me, myself, or anyone in my team by going to that website. You can go online to homestreet.com/UW. You can scan that QR code, and that will take you to the website. You'll be able to see my contact info and my teammates, other loan officers that also work at the Affinity department with me. And then my contact information, of course, you can go to my website, you can email me, you can call me, okay? And so that's the home buying process in a little knot, okay? Any questions at all, Anna?
Yeah, thank you so much, Jessica. It's always a great refresher and lots of good information. The one thing I will just add before we've had one question come in, so I'll give a few minutes here in case people are typing. As you just mentioned, you also do a talk on buying a home with down payment assistance, and we're going to be doing that in June for those of you who are interested in that particular topic. So stay tuned to the Whole You for that. And of course, as Jessica also mentioned, HomeStreet offers consultations. So if you're just interested in learning a little bit more, you can meet with them. We'll also be putting that information, refreshing it on our site. It's something that we used to do in person and has now come back kind of with a new model. So excited to relaunch that offering. All right. Margaret asks, can you elaborate more on what is the closing costs? Thank you.
Yes, absolutely. So closing costs is the cost of financing the home. And so it's not just your down payment, right? It's in addition to the down payment, you're going to have the cost of financing that home. And that involves credit report fees, for example, which are $49. FEMA will give us a map that says whether you're in a flood zone or not, and that's $11. Escrow and title insurance, handling the closing of your loan, those are costs as well that are part of financing the home. The appraisal that we spoke of, you're going to also have home insurance against fire, the full 12 months. The first year is paid at closing to your choice of insurance company. And usually, especially if you have less than 20% down, then the lender will be handling the payment of property taxes on your behalf. And so we'll collect enough money up front to start a little prepaid account so that it builds up. And then twice a year, we will pay property taxes on your behalf to the county. And so all of these numbers, right, costs will be part of the cost of financing the home, and these are the closing costs per se. The other piece involves the interest rates and so-called points, right? Each interest rate has a cost or a price associated with it. You'll hear the term points, like how many points did you pay to get that rate? Usually a point equals 1% of the loan amount. Some people really want to pay a lot more to buy the rate down, something you can do. That's also part of the closing costs. And that would be in addition to the 2% range that I'm giving you, right? If you want to pay a fortune to do that, you can. It may or may not be advisable, right? You want to talk to the lender to see if that makes sense. And so closing costs include taxes, insurance, basic closing costs, and then the so-called points are in addition, but it's not included in the down payment. That's what those are.
Another question is, you mentioned locking down the interest rate. Are there also floating mortgage rates available with HomeStreet?
Locking down the interest rate, and then you got cut off, honey. What was that?
Oh, sorry. Are there also floating rate mortgages available with HomeStreet?
So when you get pre-approved, you get pre-approved based on current market rates, and then you're floating. You're just floating until you find a home and make an offer on a home, and then you lock. So once you're pre-approved, you're not locked, you're floating, right? But can you lock an interest rate before you find a home? Can't, right? And the main reason is that it could be 30 days for you to find a home, and it could be 6 months or a year, right? And we don't know where the rates will be at that time. So rates change every day and sometimes twice a day. And so that's a really good reason for you guys to, let's say you're approved up to 900,000. I would base my search on 800, right? So that you leave some wiggle room in there for market rate increases as you're out there shopping for a home. But you cannot lock an interest rate until you've made an offer on a home and the seller has accepted it, because then you're in contract.
All right. Next question is, how much is typical earnest money?
You know, that's a really good question. And it could be as little as 1% of the price, $2,000 or so, but it signifies to the seller how serious you are. And so if you have competing offers, I've seen purchase and sales agreements with $100,000 in earnest money, right? And you're basically saying to the seller, there's no way I'm walking away from this home. So you want to accept my offer, right? Because that earnest money is what's at stake. So that if you halfway through have a change of heart and decide you're moving to Hawaii, right? That leave the seller hanging, that seller's gonna have something to hang on to, something that you have at stake, okay? And so the bigger that earnest money is, the stronger the offer, the better the chance you'll have of having the seller accept your offer. But it depends, right? It's a strategy. It's part of the strategy. You want to talk with your agent and see, okay, well, are they expecting multiple offers? Are there maybe some offers already on the table and you're just making yours now? So you're going to have to put your best foot forward. Mm-hmm.
All right. And what is the difference between loan officer and mortgage broker?
Well, I've been with HomeStreet 11 years, and before that, I was a mortgage broker for 15. And a mortgage broker is a third party. You are going to have access to different lenders, and depending on the situation of your client, you're able to send your loan to lender A or B or C, and then they approve the loan, and the loan documents and loan payments are made to that lender where you secure the interest rate. So mortgage brokers have access to different lenders, and those lenders have different options for clients. I ended up switching into a mortgage lending bank because I wanted to have more of a full house option, right? Being able to offer home insurance, car insurance, interest rates, our own loan programs, and then being a little hybrid. We have different products where we're able to provide wholesale, at the wholesale level, different loans that we are able to, that are not HomeStreet, right? But we're a bank, and so we're more of a full house. And what I like about it is that instead of having different relationships out here with different lenders, instead you have very strong relationships with your underwriters and your processors and full knowledge of your products. And then I feel like we can be a little bit more hybrid, a little bit more flexible, faster, because you've got really strong relationships. So if you need something really fast, you can do that. Or if you need an exception, you can do that, or a quick answer. The main reason I switched from brokering to lending is that after the financial crisis, brokers, the rules made their products, made the broker have more risk. If for some reason that lender failed, that loan failed, that broker ended up they made him responsible for that loan that did not work. And so the risk for brokers ended up increasing, and we saw a flux of a lot of brokers moving into more of a banking lending structure. So they're both good. It's good for you guys to compare, right, and see what's out there, and then just make a decision based on some of a gut feel, right, some comparison. Make sure the person can explain things to you well and that you understand, and that you get that sense of trust, that they have, your best interest at heart. What I would do.
Yeah, Thank you, Jessica. That's a great deep dive. I didn't know that history there.
Oh,
So
yeah.
the next question is, does a 3% down payment require PMI?
Oh, yeah. So PMI is mortgage insurance. And if mortgage insurance is required as part of your monthly payment when you have less than 20% down payment. And so if you have 20% down payment, and if you have a conventional loan, then you don't have to pay monthly mortgage insurance. But most of us have less than 20% down payment, right? And so in order to make home affordability and making it easier for buyers to be able to purchase a home, they came up with this mortgage insurance. Let's have the buyer pay for it. It insures a portion of the lender's money, a portion of the loan in case the buyer defaults. And then the lender feels more comfortable lending with 3%, 5%, 10% down, right? And so that created like an open door and opportunity for so many more people to be able to purchase homes because you could do it with very little money, okay? The reason you can is that mortgage insurance is in place. And so if for some reason the client defaulted, that mortgage insurance would kick in and would cover a portion of the bank's money so that it minimizes the loss. And then mortgage insurance can be removed in the future as the value of your home goes up and that principal balance goes down, right? That equity thing that I was talking about. But it depends on your loan program. So conventional loans, which are the most popular, there's two, conventional and FHA. FHA are government insured loans, okay? Conventional loans are insured by Fannie Mae, Freddie Mac, they're conventional. And these are the ones that require 3% down payment minimum or 5%, right? Based on the notes that I shared with you. These allow mortgage insurance to be removed in the future. You have to have made payments for at least 2 years first. You wouldn't have to refinance. You just have to document that you have enough equity. You'll have to pay for an appraisal if you want them to consider the value of your home. Let's say it's gone up and up and up and it's been 3 years. And you're like, I have plenty of equity. Well, you have to pay for that new appraisal to document that, right? If it's an FHA loan, that government insured loan, the mortgage insurance is permanent unless when you buy the home, you buy it with 10% down. If you buy it with 10% down, these are brand new rules. They just rolled them out, I think, a month ago. If you buy with 10% down, then after 10 years, that mortgage insurance will drop. But you cannot get rid of it before then. And so FHA loans are more flexible, more forgiving. So if your credit scores are not perfect, FHA is the way to go. You have really good credit scores, you want to go conventional because long-term, it may be a better product for you. So just understand, you don't need to understand all the ins and outs of these loan products, right? That's what loan officers like me are for. Just have a basic understanding. So mortgage insurance insures the lender in case the buyer defaults, and it's required if you have less than 20% down payment. All right?
All right, thank you. So I've still got a few questions. We've got about 9 minutes, so I'll just keep going down the line here.
Mm-hmm.
The next one we have
Yeah.
is asking, obviously interest rates are a bit higher now. So this question is, how soon after you purchase can you typically refinance? And are there loans that are not eligible for refinancing down the line?
Yeah, that's a very good question because you're right. Interest rates have increased, right? And so as long as you can get pre-approved and that monthly payment feels comfortable to you, say, get your foot in the door and take advantage of being able to buy a home today. And then think that you may be able to refinance in the future once rates come down. Now, you only refinance if it makes sense, right? If you're at 6% right now, and a year from now rates are at 5.5, it may be worth it, it might not be. We can take a look at some numbers then, right? Usually you want to drop the rate 1% or more for it to be worth it. And so, these closing costs that we have been talking about, when you refinance, you'll have them again. And so at that time, though, because between the principal balance that you owe and the value of your home, hopefully you have some equity, you wouldn't have to write a check, you would finance the closing costs. And so when can you refinance? It could be as soon as, 6 months down the road, but we have to make sure that there's sufficient equity to finance those closing costs, right? The value has gone up and that it makes sense, most of all, right? Is it going to generate savings for you? Is it a lower rate, a lower monthly payment, and how much will it cost you to get that rate, right? Makes sense, then don't. But whether it's FHA or conventional, you could refinance. You could refinance out of FHA into a conventional loan, and we see that all the time. Okay, so it just depends on what the rates are doing. But that's the strategy for most buyers right now: is get your foot in the door. It's easier to get an offer accepted right now than it was 2 years ago when everybody and their mother wanted to buy a home because interest rates were lower, right? So you had 30 offers on the table. At least now you don't have that many. You have some, but not that many. And in some cases, you might not have competing offers. So it's still a great time to get your foot in the door as long as you're ready, right? And you feel like, you could totally afford the home and the monthly payment, then awesome. Because once you refinance, it's just going to get even more comfortable, right?
All right. This next question is also, maybe Peggy, it might be good to connect directly on this, but so Peggy says that they started an online application with HomeStreet, and the privacy policy with the third-party application software through Blend just had some points that they weren't comfortable with. Is that the only choice for applying for a mortgage with HomeStreet, or are there other ways to go about that, maybe if you're not as comfortable with the software or the third party?
Yeah. What happens is that in the benefit of completing an application online is that you can then sign most disclosures, which is like 40-some pages, electronically, right? And so it saves paper and time, and it's so much more convenient for everyone, which is why it's there. The third party thing is that it's not just HomeStreet, it's also the company that produces those disclosures, right? And so first and foremost, we don't share your information with anyone. Not even if you want a home insurance quote. I have to get your permission for that company to send you a quote if you wanted to get a courtesy quote for insurance via email. So we're not going to sell your information. We're not going to provide it to a marketing list, but it's not just HomeStreet that makes this Blend product available, right? And so in that application online, you are agreeing that it's not just HomeStreet, it's other parties that are also involved. So if you don't feel comfortable with that, we could take an application for you over the phone. And then all the disclosures would be sent to you. Like we could send them to the nearest HomeStreet Bank branch where they would print them and you would go in there and sign them. Or you could just meet with us in person and get them signed at that time. But you wouldn't have that benefit from, it's just speed and convenience of being able to do most signings electronically, okay? And so, but I understand the concern. The other thing that I want to take a moment here, I know we have 3 minutes, but after you apply, you are going to immediately start to get either emails or phone calls from creditors. And so the best thing to do is to go to the do not call list, make sure you're registered. If you need, I can send you, Anna, if you'd like, the information for people to opt out. And it's not that HomeStreet shares your information, it's that as soon as you apply, the credit bureaus have that information available to all the creditors that are linked to the credit bureaus, right? And so the best thing you can do is just go in there and opt out, okay? That way it will minimize that impact. But it's not something that HomeStreet or another lender is doing. It happens, it's triggered by the credit report.
Yeah, that would be great. I can send that sheet out if you send that to me. That's a good note as well.
Yes, I will. Mm-hmm.
Yeah, a few more questions here. So I think we'll get in right at time. One is, are you able to rent out your home or do Airbnb if you get a mortgage with HomeStreet?
Well, if you purchase a home and you're purchasing the home as a primary residence, right? Then you're getting interest rates that are based on the purpose of the home being for you to move in, right? Not for you to then rent it out or Airbnb it. So in all the legal documents that you'll sign, you'll notice that it states you agree to occupy the property as your primary residence for at least the first 12 months, okay? After that, if you decided you're going to rent it, you're moving to Europe and you're going to Airbnb it while you're gone, that's fine. But if you are not sure that you're going to be able to live in the home for the first 12 months, then that becomes an investment property or rental. And what happens with investment properties is that the down payment required is 20 to 25% down, and that the interest rate is going to be higher than it would be if it's your primary residence, right? And so on your application, it asks you, do you intend to occupy the property as your primary residence, yes or no? And if you say yes, you need to make sure you can be there for at least 12 months.
All right. And the last question is talking again about that mortgage insurance. How much is it and how is it calculated?
Wow, that's a really good question because it depends on how much down payment you have and it depends on your credit score. So it's very credit score driven. So imagine that I have a chart and that on this side I have 3% down, 5%, jumps into 10% down for different mortgage insurance rates, 15% down, and then after 20% down, there's no mortgage insurance, right? So it's a grid. This side, I have down payment, and over here, I have scores. And the scores go in 20-point increments in this grid. So you start at 760 and higher, gets you the lowest, and then 740 to 720 is the next grid, 720 to 700, 700 to 680, and so on, right? The lower the score, the higher the mortgage insurance rate. So when people say, how much is it? It depends. Depends on the score, depends on the down payment amount. So if you compare 5% down as opposed to 10% down, the 10% down mortgage insurance is lower than if it's 5% down, and so on. Okay, I wish it was just a simple, quick math formula, but it's not. But it's not very hard. Once I know what your scores are and how much down payment you have, I can help you with that. Recently, just in the past couple of weeks, they have also implemented changes where the rate is also impacted by the debt to income ratio. So how much is this monthly payment in relation to your income? And that's also going to have a small impact on mortgage insurance and your interest rates. And so it makes it not as plain and simple, just a quick, simple answer. But I hope that it at least gives you a general idea as to how it works.
All right. Well, thank you so much for all of these great answers, so many questions, and this wonderful presentation. We are at time, and as Diana mentioned, we have recorded. So if anyone wants to revisit this, it will be on our YouTube. We'll send that out via email. I can also send out a copy of the slides and that sheet about how to, stop all the people trying to get your credit from reaching out to you, is the way I understood that. And of course, Jessica, thank you
Right.
so much. Jessica's contact information is here. So if you were inspired by this session and you want to learn more about HomeStreet, Jessica is one of those loan officers you can work with. So thank you so much, Jessica. We look forward to hosting you again in the future.
Excellent. Thank you so much for having me. I appreciate it. And I'll send you that information.
All righty. Have a great afternoon, everyone.
Bye, everybody.